Hello, everyone. Good afternoon. This is Terry Torres, Area Manager of Sales and Marketing for Senior Lifestyle, here today with the Gardens Group, and we have a great presentation from Jon Lugo on long-term care and life insurance. So we will begin here shortly. I'm going to give a couple minutes for all of our guests to arrive. So we appreciate you attending today and appreciate your patience. We will get started around 1:03. Thank you. Hello again, everyone. Good afternoon. This is Terry again with our Gardens Group, which is three standalone memory care communities in Orange County, including Fullerton Gardens, Sunflower Gardens, and Valley View Gardens. And today we've had an exciting opportunity to connect with Jon Lugo. And Jon Lugo is a wealth management expert, specializing in a variety of different uh, topics. But today we're going to be speaking about long-term care and insurance, and such a needed product in today's time. So Jon is going to be dispelling a lot of the information that you need to know, and he is a great professional partner to us with a wealth of knowledge, and he is ready to share that with you. So, Jon, if you're ready, please do us the honors and take it away.
Absolutely. Good afternoon, everyone. I hope that everybody joining this call is healthy, safe, and staying relatively sane, being locked in at home with hopefully your loved ones if you still love them after 2 months of quarantine. Thank you for the introduction. It's an honor to be here with you guys, everybody that's on the call. Long-term care in the world of personal finance has been a growing topic over the years, and especially as we get closer and closer to one of the largest groups of our population entering into the age and timeline which long-term care becomes relevant. And just a couple of quick statistics that insurance companies and insurance commissioners have gathered. 70% of people turning 65 can expect some use or form of long-term care. 70%, that's a staggering statistic when you think of an insurance product like a term life insurance policy or something like that. The percentage of people that use those products is extremely low. And you compare that to a situation where more than 2/3 of our aging population is going to be in the need at some point for long-term care. It's a pretty staggering statistic. Another interesting statistic that I've come across is that nearly 4 in 10 Americans consider themselves to be caregivers for someone who's aging or ill with special needs. And if you're on this call, perhaps you are what we call in the wealth management and financial planning world, part of the sandwich generation, where you have children that you may still be supporting, whether it be through their educations, whether it be high school or getting ready to go to college, financially supporting your children, and also potentially financially supporting your parents. There's a lot of demands on that generation financially, and with everything demanding your time and your energy and your effort to be a good a parent, be a good child, to be a good business owner or employee, there's a lot of question marks when it comes to long-term care. And so today we can't cover every single piece of this, but we can cover some of the highlights. And I think I just want to preface our talk today by saying that if you have specific questions about long-term care, reach out to somebody. Feel free to reach out to me. If you have an insurance advisor that you've worked with in the past, these are going to be your experts to go to with these questions. Some of the highlights today are going to touch on, what is long-term care? What does it mean? What qualifies as long-term care? When should we start looking at purchasing long-term care? And how has the market changed over time? There are also a couple of different ways to fund long-term care, and we'll talk about that in a second. The last piece of information I just want to share with everybody on the call so far is that the average cost across the nation for private room in nursing home care, the average cost of private room nursing home care across the nation, not in California, but just everywhere, is $91,305 a year. $91,305 a year. Now you come to Southern California or the East Coast, where the costs of living are much higher, and you can imagine that number will go up dramatically. So it's important for you as a potential caregiver who may be saving for their own retirement, or if you yourself are getting close to retirement and you want to protect your retirement assets for your spouse, for your kids, or we oh no.
That sounds better.
Is this better? Can you hear me
So
okay?
much better. Yes, that's perfect.
Oh,
Sorry
good.
about that,
Okay.
folks.
Sorry. Thank you. I
Back
thought
to
I
John.
lost you. Okay. All right. Thank you. Thank you for letting me know. All right. So first of all, long-term care um, has changed over the years, and it's changed for a good reason. Years and years ago, when insurance companies came up with the product, it was a new product, and oftentimes they have to bake assumptions into products. When long-term care policies were created, they had never offered them before, and so they baked in some assumptions. They assumed, like life insurance or disability coverage, that there would be a pretty significant number of people who bought the policies that didn't end up needing to use them. And unfortunately for the insurance companies, many of them, as their clients got closer and closer to retirement and actually ended up using the policies, they found that more than 2/3 of people who had the policies ended up using them. It was a very bad realization for a lot of insurance companies. And over the years, many insurance companies that offered long-term care no longer do, or they no longer exist because they didn't have enough capital on reserve to offer more policies to new customers to replace the money that was going out to pay claims. So one thing I just want to share is that as you're shopping for long-term care options, if you're looking at policies, one of the things that we always want to look at is the financial strength of the company that you choose. A lot of the big mutual companies are fantastic for strength. Those are the types of companies, if you are able to get those policies, you want to look at those companies if you're buying a standalone long-term care product. And over the last just 9 or 10 years, the policies themselves, even being offered by these big mutual companies or companies that still offer long-term care, have changed. We used to be able to buy a lifetime benefit for clients, meaning you could buy a policy and the policy would pay a certain dollar amount on a benefit every month for the rest of the client's life, as long as they were in need of long-term care. And about 4 years ago, the insurance commissioners across the United States allowed the insurance companies to remove that option because they found that it was too costly for the insurance companies to offer that type of a benefit. So today, as we sit here on this call, there are different options, not lifetime, but for the most part about 3 to 6 years on the benefit period that you can buy. There have also, these companies that may not want to offer a standalone policy, they have created hybrid policies, and these are pretty popular. You may have come across these in the marketplace if you've done some research on the product, and we'll talk about that in a little bit. But effectively, it connects a life insurance policy that's able to be used in the sense that somebody needs long-term care. You can kind of use the life insurance ahead of time. But how does somebody qualify to use their long-term care benefit? That's a big question. And what it all boils down to is activities of daily living. And these activities of daily living are eating, bathing, dressing, transferring, continence, and using the restroom. If a person cannot perform 2 out of those 6 activities of daily living, those are the 2 qualifications that will begin what's called the elimination period on a long-term care policy. And it's very important when we look at what those mean, because depending on the type of policy you have, the elimination period or the waiting period is going to change. But effectively, the activities of daily living are what the insurance company is looking at. If I cannot get myself dressed or feed myself, then that begins the process of being able to start a claim. The other area of eligibility is cognitive impairment. And these are things like dementia, Alzheimer's, or other kinds of brain damage. So those are the qualifications to use either a hybrid policy or a long-term care policy on its own. Now, there are different types of service when it comes to long-term care, and they vary, but basically they're broken down by skilled nursing, that's really the highest level of care, and that's provided by a traditional nurse home, and that's daily care. We have intermediate nursing care, and it's similar to nursing care, except it's provided occasionally and just not every single day. Custodial care, which is a traditional nursing home and doesn't have to be recommended or ordered by a physician. Home health care that allows patients to remain at home and receive part-time skilled nursing care, rehab, or other assistance. And then we have assisted living. These facilities are apartment style or housing, and they offer support services for people who need help with the tasks of daily living. Remember the activities: eating, bathing, dressing, transferring, etc. So in the assisted living, it's less medical and more assisted on the activities. We have adult daycare options. These are care options provided for people who need assistance and supervision during the day. And then hospice. And hospice is care for terminally ill folks. And hospice can take place in a patient's home or in a facility. Now, these are the different types of service. And I'll tell you from my experience being in wealth management, financial planning, that our clients, if they have a choice, they choose to remain in their homes as long as possible until they can't, and then they may be transferred to another facility. But either way, if you're able to secure a contract with an insurance company, the insurance company doesn't need a client to go to a facility. That's actually a big piece of long-term care planning. How do we keep our clients in their homes as long as possible with benefits that don't make them spend down their assets? So when we look at long-term care policies are going to have different percentages of coverage for these different types of service. And it can get a little confusing, right? If you have a policy that covers 50% of skilled nursing and 100% of home health, I mean, ultimately, if you can choose, you want to find a policy that covers 100% of any type of care that you're going to need or that your loved ones are going to need. So let's talk about the pros and cons for just straight long-term care policies. In my personal opinion and professional experience, a long-term care policy is the best funding option to cover the cost of care. It's the best because there are no loopholes. There are no question marks. And I'm comparing these to either self-funding and selling assets to cover the cost of care, or having a hybrid policy that's attached to life insurance. Now, those are also options, but in my personal experience, I prefer for my clients to have a standalone long-term care policy. The downside, the cons to the long-term care policies, and we have clients ask us this all the time: John, I've heard that if I buy a long-term care policy and I pay for it my whole life and I don't use it, I lose it. So I could pay tons of premiums over my lifetime, and if I don't use the benefit, then I lose all the money that I put in. And at a basic level, that's somewhat true. I would love for my clients to waste the money on their long-term care premiums and never use the benefit. There are ways that you can have an insurance company refund some of the premiums to the other policy owner if somebody dies without using the benefit. But ultimately, it's kind of like a term life insurance policy that we pay for a long time. We don't get to take equity against it or have any flexibility. So that's a con, right? The benefit periods are defined. You can use either a defined period, so you could say, hey, I'm going to buy 3 years of coverage, or I'm going to buy a pool of money. We take the pool of money approach most of the time because in the case that somebody needs care and they need it for a year and then potentially they get better, well, we don't want to have to turn the benefit off. You can spread the benefit out with a pool of money approach. If your benefit's $10,000 a month and you only use $5,000, that benefit's going to last a little bit longer than a defined period. So a couple different options there. The elimination period is one of the biggest pieces that we look for when we buy long-term care policies for a client. And the elimination period says when client Smith needs long-term care and their physician says so and they're having issues with activities of daily living, there's a 6-week or a 12-week waiting period. And in those 6 or 12 weeks, the client must self-insure. But how do they satisfy that 6 or 12 weeks? And in some cases, it absolutely depends on the insurance company and the language of the contract. But in some cases, a policy will say that someone needs full-time care for 6 weeks in a row. And once they've satisfied that, then the benefit starts to pay. Other companies will say that if someone needs care 1 day a week, that 1 day satisfies an entire week. And there you can see that there's a huge difference between these two options. So it's very important, again, when we look at these policies to understand the calculation of the elimination period. That is essential. The premiums and the options on the policies have been mandated in some cases, like in California and other states. The benefits by law have to increase with inflation. And that's because the cost of long-term care increases at over 5% every year. You're right, inflation's 2.5% or so. Long-term care is twice that. So people years ago had purchased policies and 10, 20 years gone by, and they go to use the benefits and realize that their benefits only cover half of what the long-term care costs are when they go to use them. And so the insurance commissioners, and this is in most states, including California, have decided that each policy must increase the benefit with inflation, and your premium goes along with it. There are many ways to fund the premiums, but know that you can choose a level option or choose it to increase with the benefit over time. Like we talked about a few moments ago, that survivorship piece says if my wife and I have long-term care policies and I pay my premiums and I die without using it, then my wife can use my premiums paid in to cover her benefits as well. So there's some options there also. A lot of policies and insurance companies have options where if two people go in to purchase policies, they will give discounts. So if my wife and I apply for long-term care benefits and we're both approved, I've seen it as high as 20% on the discounted premium because we both bought policies at the same time. If I'm declined and my wife is approved, then she will have a smaller discount, maybe 10% off of her premium. So insurance companies want to incentivize couples to do this. And on the other side, the government is incentivizing us as well. The government actually, if you own a business, if you own a small business, your long-term care premiums are tax deductible. And that is a big deal. If you own a small business and you buy a long-term care policy and your premiums are, a few $1,000s a year, well, we can't write off our clients' life insurance premiums or their long-term disability premiums, but we can write off their long-term care premiums. Pretty outstanding. So there are some other options when it comes to long-term care contracts. There are some policies that are called partnership policies. And this essentially works with Medicare. The Medicare requirement for somebody to qualify to use Medicare as a benefit for long-term care says that the client, the person needing the Medicare benefits, has to have approximately $2,000 in assets to qualify. $2,000 in assets. So if your loved one, your aunt, uncle, parent owns a home, that is excluded outside of the primary residence. But if they have a retirement account with any money left in there, that has to be gone in order for them to use Medicare as a benefit. The partnership policies say that if mom or dad has a $500,000 IRA and you buy a $500,000 pool of money long-term care partnership plan, then guess what? The long-term care partnership plan basically covers up that IRA for mom or dad and does not include it in the calculation. It's pretty cool. And it gives people the credit, the clients, the credit for the amount of money that their policy was purchased for, the pool amount, the pool of money amount. Um, some alternatives to long-term care, right? We can use different options. Biodical settlements are one option, and that's when our clients exchange life insurance policies to a biodical settlement company. They purchase the policy from the client, give them a cash upfront, and then the policy is owned by the biodical settlement company. When the client passes away, the biodical settlement company gets the benefit. We also have those hybrid policies we talked about. There are a couple of really popular ones out there. Lincoln MoneyGuard is a very popular product over the last few years. And the benefit is you give Lincoln money, and if you don't use it, you don't lose it. There's a life insurance policy attached to it. The challenge that we run into sometimes is that the premiums are large. A lot of times they're lump sum premiums, a couple $100,000 at a time. It does buy a big death benefit for the clients, and that death benefit gets chopped down when we choose to use it for long-term care. And then if there's anything left over, that death benefit gets paid out to the estate or to the family. The Medicaid option is not ideal, and most of our clients, I think most of the people on this call will probably not qualify for those Medicare benefits. And to be honest, I mean, even if we could, it wouldn't be what you would choose. The state-sponsored benefits aren't as desirable as the private benefits that you would want to have for your retirement or for your loved ones. And then self-funding, right? And this is always the default. If we meet folks, about 60% of my clients are over the age of 65, so they are in the distribution phase of life. And when we meet them, it's often either right before retirement or right after. And we start working with them. And if they have not purchased a long-term care policy, oftentimes it's very difficult to do that due to health reasons or costs. And so we, as planners, work with our clients to make sure that there is an adequate way to fund long-term care from assets. Ideally, if we could do it from liquid assets, that would be much more preferred than to sell an asset like a business or a piece of real estate to cover the cost of care. A lot of times our clients want to leave the assets that they built for their families and their loved ones, their charities. They want to leave those behind and for the people they care about. They don't want to use them for an extended care event. But if we have to do that, we absolutely will. The important thing with self-funding is to determine which assets are going to be sold before care is needed, because at that point the kids are getting involved to find out what assets are being sold to cover the cost of mom or dad's care, and it can get a little complicated when there are more than a couple of people involved. But those are our options. There are about a million things that we could talk about when it comes to long-term care, and I think the most important part here, everybody, is just to know that there are right now, especially, many options to cover our loved ones, our families, ourselves in the event that there is a need for long-term care down the road. This is a conversation that our clients are willing to have. Very few people are excited to have it. But if you think back to when you bought your first life insurance policy, maybe when the kids were young, perhaps, that wasn't very exciting either. But one of those necessary pieces of financial planning, especially for those of us who have planned well and who want to create options for the people that we care most about. So I know we couldn't have covered everything today. I hope that just running through a couple of the high-level pieces of this were helpful. Remember, when looking at a long-term care policy, there are so many options out there. I highly recommend working with either your insurance advisor, your financial planner, or feel free to touch base with me and my team. We're happy to answer any questions that you might have. But remember, right, there are many options that we can look at. The market and the landscape is changing. Keep an eye out on using an insurance company with financial strength if you are looking at buying a single standalone long-term care policy, and make sure we understand, what types of care are covered at what percentages under the policy language. that is about all I have for today. I asked if there would be any questions before this call, and if anybody on this call does have a question, if we maybe can unmute the line, I'm happy to take questions today if we have a few minutes. But I'll turn it back over to the people in charge.
Thank you, Jon, so much. We really appreciate the presentation, such great information, and definitely encourage every single person on the call to get in touch with you. Um, you have the contact information there. And like I say, Jon has been such a great partner to us and really trust his judgment and his advice on these topics. And absolutely, we'd want to open the floor for questions at this time. So if you wanted to type them in the question section, I'll be happy to read them off to Jon. So while you all are typing those and thinking about different questions that you need to have answered, we do want to share with you, of course, to get in contact with our communities. You can go to seniorlifestyle.com to find a local community to suit your needs. And then also the communities in Orange County, which can provide dedicated memory care services, Fullerton Gardens, Sunflower Gardens, and Valley View Gardens. And we do have a question here. And Jon, the question is, what are the requirements for approval of an LTC plan?
That's a great question. Thank you for whoever asked that. So unlike a life insurance policy or a long-term disability policy, the requirements to apply, because that comes first, do not include a medical or paramedical exam. So when you buy a life insurance policy, a nurse comes to your house. Oftentimes, they take some bodily fluid samples, they ask you some medical questions, measure your height and weight, and then they leave you alone. In the case of long-term care, it is not allowed for an insurance company to do a paramedical exam. But what they do is they want a full application with some medical questions, and then the insurance company has our clients sign a HIPAA release form, all confidential, and the insurance company will review medical records. So in order to be approved, the insurance company has to look through medical records and find out, okay, are there anything, any items or any issues that we would be concerned about so this client needing long-term care. So it's not quite as invasive a process to apply, but it is very thorough. It does take a while to get an approval back from a long-term care policy insurance company. It could take up to a couple of months on average, usually about 2 to 3 months, because there's no medical exam and because they have to wait for the doctor's records to come back. I will say this: it's very easy to buy life insurance. It's not very easy to buy long-term care. And when we talked about the different options, right, either buying a standalone policy or buying a hybrid policy, in my experience, it's a little easier to buy a hybrid policy than it is to buy a standalone long-term care policy, meaning health history issues that would potentially decline somebody for long-term care. If we're buying a hybrid policy, those insurance carriers may be a little more lenient since there's a death benefit, and a portion of that is going to be used for long-term care as a secondary benefit. I hope that answered the question. If you have a follow-up question, I'm happy to answer that as well.
We do, Jon. There's another, thank you so much for that answer, and definitely keep the questions coming. There's another question that came in, and it says, is there a cap on the LTC benefit amount?
Yes, there is a cap, and that's basically what we buy. We kind of buy the cap. So when we buy a policy, and I have a meeting later this afternoon for a couple, 68 and 66 years old. Now, the husband has a policy. He bought it a long time ago. It's worth about $5,000 a month. And he's buying another policy for another $5,000 a month. And so, for example, that $5,000 a month is the max benefit that this client can use. But if you think back to that pool of money approach, when you buy a $5,000 per month benefit, let's say that we buy it and it has a 3-year payout. So $5,000 a month is $60,000 a year. Multiply that by 3. That's a $180,000 pool of benefit. Now, if this client needs long-term care, and if his long-term care costs less than $5,000 a month, then it will pay out for longer than that 3-year period. So if it doesn't really matter how long the payout period is, as long as we buy enough benefit on a monthly basis. So anything under what that max monthly benefit is, in that case, just gets tacked back onto that big pool of benefit to be used later. And we have a client who has been on claim for, oh gosh, at this point, I believe it's 12 years. And she bought a 6-year benefit period. She's been on claim for 12 years because her cost of care is less than the maximum. So that's how we shop for these benefits. We shop based on the maximum monthly benefit, and we decide, okay, the average cost of care in California is $10,000 a month. That's full-time care. And most of that is in-home or in a facility like the Gardens Group. These costs are about $10,000 a month today. So if we were buying a $10,000 a month benefit today, we know that that's the most that benefit would pay out every month. And hopefully, with these policies increasing with inflation, by the time that policy is used, that $10,000 has become larger to keep up with the rising costs of care across the country. I hope that answered your question.
Okay, thank you for that. And then we have another question here. If a person is 55 years old and 7 months out from breast cancer surgery, did they have to wait a couple of years before they can even apply for LTC?
That's a great question. That is an excellent question. Have to? No. And here's the best and worst case scenario. The best case scenario is the insurance company takes a look and they give us guidance. They look back at medical records, they look at the doctor's notes, they look at the diagnosis and the treatment. It's very comprehensive. And they'll say, look, this client, this far out from this surgery, you know what, we're not ready to offer a policy today, but if your client is symptom-free, or if your client is treatment-free, or there are no further complications, please come back to us 6 months, a year, 2 years from now. They'll at least give us guidance. And I'm really glad that somebody asked that question, because I meet people all the time, and when I ask them, if they've purchased a policy or if they've wanted to, I hear that a lot. And people will say, gosh, you know what, I had this and I didn't think I could apply. And you can. You absolutely can. In my mind, and this is how I would want to know too. I would like to know what my options are. Best case scenario, right? Worst case scenario, they just say, no, sorry, it's not us. We know that there are many options out there, right? And if you can, you start with the pickiest insurance companies, because those are the companies that'll be around to pay the claims. That's the Mutual of Omaha, the Northwesterns, the New York Lights, these big mutual firms, and they're pretty picky, but they'll also do the best job underwriting, and they'll give you wonderful guidance on what they want to see in order to offer a policy. And if you don't want to use them, you go somewhere else and maybe you look at a hybrid plan. But keep in mind that we're talking about activities of daily living too. So in the case where, where a medical issue wouldn't necessarily create issues, using or being able to perform activities of daily living, but are a danger to someone's, life. They could that could kill somebody, right? Cancer could kill us. It may not put us in a situation where we can't feed ourselves or bathe ourselves, but it may kill somebody if it's not treated. So I know it might sound a little off, but in some cases, the insurance company's looking at it as, okay, is this person going to die because of their health history, or is this person going to be physically alive and somewhat capable, but at risk of not being able to perform those activities of daily living? So a lot of cases, we have clients who have recovered from cancer who can't buy life insurance, and in some cases, they can buy long-term care. So it's a very interesting thing. And I would just say to that specific question, with that timeline, that is a little close to the diagnosis or the treatment or being cancer-free. But because that was the last diagnosis, it's worth investigating for sure. Can't hurt to investigate and get an answer for yourself so that you know what the next steps are.
Okay, thank you so much for that answer. Does anyone else have any other questions, either verbally, or if you want to type it into the question box that we can ask Jon about today?
Well, three is my limit for 3 questions. Anybody else that wants to ask one owes me a lollipop or a marshmallow or something. Just kidding, guys. Any other questions? Happy to answer while we've got a few more minutes. Otherwise, feel free to reach out to your group here, the Gardens group, and everybody that has put this on. And in addition, I'm sure that they'll be sending out information with my contact info and theirs. You can reach out to them and they can get a hold of me, and vice versa. If you want to reach out to me and you need to reconnect with them, I can put you back in touch with them also.
Absolutely, Jon. We will be sending out the PowerPoint presentation so that everybody could have that handy. And then in that presentation is going to be all of your direct contact information as well. And that way they can connect for deeper discussions on this and to get your advice and assistance. There's just one more question that came in, however. It says, what do you do if your LTC has been exhausted?
Oh, if we've used all the benefits.
Mm-hmm.
Well, goodness, at that point, we need to start looking into one of the self-funding options, perhaps, or using the spend-down provision in the Medicare options. Those are basically our two, unless there's a life insurance policy in there that we can exchange for value or use cash value within to continue the care. So that is a planning 301 question. That's a fantastic question. And a lot of it's going to depend on what assets are available, what income streams are available. And so whoever asked that question, please reach out to me. If that's you or if that's a family member, that is absolutely something that we need to look at with a lot of detail so that we know which option is best, especially if we're talking about self-funding. Because gosh, look where we're all at, right? I'm sitting in my house instead of my office like all of you. And if the assets for the person we're talking about outside of long-term care are in the market, then that's going to take some expert analysis to know what to do with those accounts, right? We're all down double digits still year to date in the market. So please reach out to me directly because there's no silver bullet for that, but there are definitely options that you can look at if the long-term care benefit's been exhausted.
Okay, that sounds good. And then I'm gonna read off your email address as well for those that are on the audio portion and maybe can't wait to get the PDF version of our presentation. So it's Jon Lugo at nm.com, and please feel free to email and connect with Jon directly again. And we thank you so much, Jon, for your time today. It was an excellent presentation, such great information. And to all of the attendees, we thank you for your time, and we'll definitely be getting you the PowerPoint presentation, and we're all here to help. So please feel free to connect with any one of us. We're here to help and wish you all well and a great day.